In April, the US shook global trade norms by announcing sweeping tariffs. Our April report offered a range of estimates for the resulting growth downgrade, from modest to significant. 6 months on, where are we? The good news is that the growth downgrade is at the modest end of the range, with growth projected at 3.2% this year and 3.1% next year, while inflation has increased modestly and is proving more persistent. The tariff shock itself is smaller than initially feared, with many trade deals and exemptions. Most countries also refrained from retaliation, keeping the trading system open, and the private sector proved agile, front-loading imports and rerouting supply chains. Second, financial conditions remain loose, in part because of a weaker dollar. In some countries, such as Germany and China, fiscal policy turned expansionary, and in the US, an AI and tech-driven investment is booming. Yet, despite all these offsets, the tariff shock is here, and it is further dimming already weak growth prospects. This is clear even in the US. Growth is revised down from last year, the labor market is weakening, and inflation has been revised up and is persistently above target, signs that the economy has been hit by a negative supply shock. Where do we go from here? The outlook remains fragile and very sensitive to news on the trade front, as I'm sure all of us have noted. Flaring up trade tensions with the potential for supply chain disruptions could quickly lower global output by as much as 0.3 percentage point, as we explore in our downside scenario. Besides trade tensions, I want to quickly flag 4 other downside risks. First, there are echoes in the current tech investment surge of the dot-com boom of the late 1990s. It was the internet then, it is AI now. We're seeing surging valuations, booming investment, and strong consumption on the back of solid capital gains. The risk is that with stronger investment and consumption, a tighter monetary policy will be needed to contain price pressures. Second, there are continued concerns about China's growth model. The bubble in the property sector remains a source of weakness. Growth in recent years has come from exports, but it is increasingly hard to see how this could be sustained, and the economy remains uncomfortably close to a debt deflation trap. In too many countries, insufficient progress has been made to rebuild fiscal space. The situation remains precarious, with lower growth, higher real interest rates, elevated debt levels, and new spending needs such as defense, economic security, or climate adaptation. Low-income countries are even more vulnerable, as they face the prospect of reduced aid flows from richer countries. The lack of growth prospects could morph into social unrest, particularly among unemployed youth. Fourth, as fiscal constraints become more binding, we are seeing rising pressures on central banks. Calls to ease monetary policy, whether to support activity or reduce government debt service at the expense of price stability, always backfires. While these risks are serious, all is not gloomy. A few important developments could quickly brighten the outlook. First and foremost, resolving policy uncertainty with clearer bilateral and multilateral trade agreements and lower tariffs can help boost output in the near term. Second, AI has the potential to increase productivity. Many of us are already using it, and we can attest to its benefits. Improved domestic policies will also go a long way to help improve resilience, reduce macroeconomic risks, and help resolve global imbalances. Restoring fiscal space where needed, improving the efficiency of public spending, ensuring independent, transparent, and tailored monetary policy, and above all, adopting government policies that invest in the future and empower private entrepreneurs to innovate and thrive.